Today's show is sponsored by CloudZero. For software-driven companies focused on growing margins, CloudZero is the only cloud cost intelligence platform that puts engineering in control by connecting technical decisions to business results. By analyzing cloud services like AWS and Snowflake, CloudZero provides real-time cost insights that help you maximize margins. Engineering teams can answer critical questions like, who are my most expensive customers? How much does this specific feature cost our business? What's the cost impact of re-architecting this application? With cost anomaly alerts via Slack, product-specific data views, and granular engineering context that makes it easy to investigate any cost, CloudZero is your complete cloud cost intelligence platform, connecting the dots between high-level trends and individual line items. Join companies like Drift, Rapid7, and SeatGeek by visiting cloudzero.com/cloudcast to get started today. That's cloudzero.com/cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Another Sunday Perspectives, middle of December 2022, finishing up the year. We got just a couple of shows left. Actually, the last couple of shows we've got left are going to be both kind of an end-of-year wrap-up as well as predictions as we typically do, and then we'll do an end-of-year mailbag. A couple of shows that hopefully will allow you to, if you're traveling some for the holidays or if you're, just looking to get away from work and kind of spend some downtime and some quiet time, it'll give you some longer shows to listen to. Today we're going to kind of do sort of a couple Sunday Perspective shows, but we're going to talk a little bit today about kind of where we are in the economy as it relates to technology. Obviously, we're not going to dive into macro or microeconomics, but just kind of, where we are in terms of, the technology cycle as it relates to the economy. The two are always interconnected. And we're really going to kind of look at where we are today as of, at the end of year 2022. We are towards the end of the pandemic. The pandemic, I guess, is still going on in some places and unfortunately still kind of coming back in some places. But, kind of looking at what's gone on through that period of time, but also looking at, are we in a bust cycle? Are we in a downturn cycle? Are there still opportunities for, kind of boom within these types of cycles, and kind of look at all those different things. Not only, how do we identify where we are in a given cycle? Because that's always important. It impacts the types of things that we invest in, the types of things that we prioritize, but also looking at, how do we, as individuals, as groups, kind of try and determine where we are. What are the things that tend to happen? What can we learn from the past in terms of boom and bust cycles and kind of upswings and downswings and so forth? And I think it's always important to highlight some of these things as somebody who's lived through several of them. Some of you maybe kind of are new to all this. Again, we've talked a number of times. This is really kind of the first time in a number of years that we've seen sort of an economic downswing. Obviously, we saw some things in the short term happen around the beginning of the pandemic. Lots of money got pumped into the system, and the system kind of exploded for a couple of years. Now we're starting to see the effects of that. But what we're going to try and do in today's Sunday Perspective after the break is dig into, how do we figure out the good times, the uncertain times, the bad times? What can we learn from history? How can we sort of understand where we are at any given point? But maybe most importantly, what are some of the reactions you can expect to see? What are some of the actions you can expect to see from employers, investors, colleagues, and so forth as these cycles sort of change, because they do have, in many cases, a very material effect on a lot of people, and it's important to kind of understand what people do, what they tend to do, what we've seen historically, and we can maybe predict about what might happen going forward. So we'll do that after the break. Today's episode of the Cloudcast is sponsored by Datadog. Bring speed and scale to your security organization. Datadog Cloud Security Platform delivers real-time threat detection and continuous configuration audits across applications, hosts, containers, and cloud infrastructure. Built on top of the observability platform, Datadog brings unprecedented integration between security and DevOps aligned to shared organizational goals. As a listener to the Cloudcast, you can sign up for a free 2-week trial to see for yourself how Datadog can elevate your cloud infrastructure security posture by visiting datadog.com/security-cloudcast. Sign up now and receive a free Datadog t-shirt. That's datadog.com/security-cloudcast.
It's our mission to give IT pros a break. So here it is. wish it was longer. But to keep saving IT pros time and money, we only paid for a 30-second ad. From racks and PDUs to backup power, Eaton and Trip Light have joined forces to bring more sanity to your day every day. Visit eaton.com/audio today.
And we're back. And, as I mentioned at the top of the show, we're going to kind of figure out where we are in the economic cycle as it relates to technology. We're going to talk a little bit about what we can learn from history in the context of where we are today versus maybe where we'll be in 6 months or a year or 18 months. And we're going to look a little bit at what can we probably expect from, the different aspects of our industry, whether it's large companies, small companies, VCs and investors, the finance community, ecosystem that surrounds the biggest companies, those types of things. And it's important to again, kind of understand and have some context of where we are, especially if you are newer to the industry, and again, newer to the industry could be 2 or 3 years. It could be 5, 10, 8, 12 years. Because again, we really haven't seen something like this, really the last couple of years in a long time, really since about 2008 when we had the last really big kind of financial crash, the housing market and what they call subprime market, had a huge impact on really financing. So I want to kind of walk through a lot of some things that Aaron and I have learned over the years. Having done this for, I think we're coming up on 12 years, maybe. Almost 700 shows. One of the things that you get relatively good at in doing these types of things is you see a lot of things over and over again. I joke all the time about something I call Gracely's theorem, which is a joke. There is no real Gracely's theorem, but the premise of it is that there are very few new ideas in technology. There's really only a couple of things that change. One of them is the cost of computing, and the second one is the ability to have greater bandwidth between the things that you're trying to connect with your computers. And when those things significantly change, then you tend to see ideas that maybe in the past weren't viable but become viable. Anyways, the reason I sort of throw that out is you do this type of job where we get to talk to a lot of people over and over again. And I'm sure many of you, engage with a lot of different technology communities and vendors and groups and so forth. And what you begin to see if you pay attention is you start to see a lot of patterns, and you start to see repeatable patterns. And so, one of the reasons that we do the Sunday Perspective show is not to sort of always be historical, although I know some people like to joke around that the show has a little bit of a historical bent to it. And I know there's some people that do things like that. Paul Harvey, if you will, for any of you that are younger, go look up Paul Harvey. Used to do lots of sort of interesting historical monologues. I definitely don't put myself in that category. Paul was really just a master and a genius. But I do think there is a lot of value in sort of looking at things historically and being able to get yourself out of the day-to-day context, sometimes the hype context, the personality context that oftentimes goes with companies and vendors and new technologies, and be able to look at it from afar, kind of get yourself out of the original context, look at it from afar, look at it from the perspective of what's going on economically, right? So, there's always a couple things that we talk about on the show. One of them is, have some historical context, because you will see patterns that emerge and repeat themselves. And sometimes, you'll sort of go, okay, even though I don't totally understand this, I have seen this pattern before. That'll help you learn faster. One of the second things we talk about all the time is learn to follow the money. And, you may be a technologist and you go, well, I have a checking account or a savings account, or, I have some sort of investment, but, understand the money in this industry, because it can be significant. It can be highly leveraged, meaning, $1, put up against $10 borrowed, highly leveraged, or $100 borrowed, whatever it might be. Understand some of those basic things. And it's the reason why we talk all the time on the show about, revenues, but we also talk about, money that's been invested in companies. We try to talk to VCs. It's really important to understand some basic things, in any given period of time. Is money cheap? And by cheap, I mean it is, very low interest rate to borrow money. Do people have a lot of free cash flow that they are looking to invest, and that money gets, aggregated into investment funds, whether those are VC funds or hedge funds or whatever. But the ability to get that money, whether it's raised through banking or debt, or whether it's from the government, or people just are part of businesses that have a lot of free cash flow. Understand where does money come from? Is it cheap? Is it expensive? Is it highly leveraged? Is the way in which money is deployed highly leveraged, such that when things are good and things continue to kind of go up and to the right, the system works very well. But at the point where that trend changes, that trend stops going up and to the right, it slows down by some velocity. It starts to go negative, if you will. Is that high leverage going to create kind of a house of cards situation? And we've this tends to be the reason why things accelerate like crazy, because people don't actually put as much money in. The money they do put in is at very, very low interest rates. It's very cheap money, if you will. But then the system, in order to accelerate and create greater profit levels, create greater growth levels, create greater returns, tends to become highly leveraged. And those highly leveraged things essentially are debt. Somebody is responsible for the money, and at some point somebody wants that money back. And so understanding how those things happen, what's going on is really important at any given time. I think sometimes we forget about them. We have a collective bias and blind spot for when things are really good because of cheap money versus when things are really good and sustainable because of sort of normal or higher, more expensive money, if you will. It's also kind of good to understand the motivation of things. And I think, we saw this year, and we're going to do a whole recap of sort of the crypto space. We saw a lot of VCs, not only, investing money into things such as crypto, but becoming the biggest cheerleaders of those things. And, you have to sort of understand the motivation, behind most people in this industry. It's great to hear about new technologies, but, why are you talking about something? Why are you standing behind something? Why are you exclaiming the virtues of something? Always, kind of get back to, what's the motivation of this person? How do they make money? Where does their money come from? I think the second thing to sort of understand when you're trying to figure out what's going on, are we in boom times or bust times, is, can the technology trend be explained to a layperson, right? You take something like cryptocurrency, for example, and most people couldn't understand it. They saw a lot of things kind of going up. They saw lots of hype. You saw lots of articles everywhere from TechCrunch to Wired Magazine to blog posts, but then they were on CNN and they were on sort of mainstream things. But, I think if you went and talked to most people, even a lot of people in the tech industry, they didn't understand it. You contrast that to something like the smartphone, and, that became something that is, widely used, widely deployed. But for most people, they could kind of understand what it did. It was like a telephone. It was kind of like a computer. And it began to do some really interesting things, and in some cases, some very simple things. And, so yes, you probably couldn't always go to your 85-year-old grandmother and explain it to you, but could people understand it? Could they understand how the system makes money? Could they understand kind of roughly how the technology might apply to them? And when the answer to those things is no, you may be in sort of a boom cycle that will quickly become a bust cycle. Those are some of those sort of characteristics. The next thing I tend to look at is, are we, can the technology itself create a sustainable business model, right? When we have situations in which something comes out, it's incredibly cool, it's incredibly interesting from a technology perspective, and then you go, hey, how is anybody going to make money on this? How are you, the center of the attention of this thing, going to make money on it? And if the answer to that is, well, we haven't figured it out yet, you are probably, in the beginning of sort of you're probably in the middle of a boom cycle, because you've gotten to the point where you're starting to ask that question. But you're also, if the answer is, we're not sure yet, but we're experimenting. Okay, maybe you still have some runway. If it's, we don't worry about that, we're just trying to grow. You're probably going to begin to start to be in a bust cycle fairly soon, because either the competition will come along and just sort of take what you have. So Docker is a great example. The early Docker, maybe not Docker right now, but the early Docker, where they never could figure out how to make any money, and then everybody around them either sort of, replaced their technology, copied their technology, or made money on it. That's one of those examples of sort of a boom and bust cycle happening. But the second thing, whenever you're looking at these things, is not only does the core thing make money, but does the ecosystem around it make money? And not just, in healthy systems, you're really not looking for sort of, the center of the technology ecosystem makes $1 and then the ecosystem around it makes $1. You're really looking for the ecosystem to make $5, $10 for every $1. And if that's not happening, if it is really sort of a winner take all, or, sort of winner takes all and the ecosystem fails, that's probably something you're going to see where you have a boom and a bust. And we've seen some of those, and we've seen things be really great. Microsoft, in sort of the ecosystem around Microsoft and Windows and Office, the ecosystem around things like VMware, sort of fit that model of, the ecosystem made a lot more money than the center of it, but the center kept getting bigger and bigger, and hence the ecosystem kept getting bigger and bigger. Amazon was that way for a while. They seem to be sort of shifting a little bit in terms of their stance on the ecosystem. But you're really sort of, looking at that. And that's, I think when we look at some of the failures of things like crypto and some of these currencies, beyond some of the fraud, they were sort of small numbers take all. You had sort of whales, running some of these coins and stuff. And that wasn't maybe transparent enough for a lot of people. As we get into sort of characterizing what do these booms and what do these busts look like, booms, they're fairly different. And if you haven't sort of lived through them, they may seem like sort of the yin and yang of each other. Booms are like a lot of things. They tend to start slow. It's something new. It needs to educate the market on what's happening. It will, as it quickly identifies value, and usually the booms are there to, they identify value fairly early. It's value that people can understand, they can share by word of mouth, whether it's social media or just amongst their friends. It begins to sort of gain momentum, and then it'll sustain for a while. Even in some of these things like we've seen with housing, or we've seen with certain technology trends and so forth. It'll start, it'll be slow. You won't be sure whether or not it's a transitional thing. It will begin to gain some word of mouth. People will talk about it in valuable sense, like, oh, this is really great because, and then it'll sustain itself for a while, and you'll start to see the mainstream market really kind of get involved with it. It'll become the center of discussions for things. And then, and then you start to, the way you sort of start to know that it's probably beginning to fade is a couple of things happen. Number one, it reaches multiple highs for whatever the measurement is, stock price or, sales or whatever it is. And you'll hear a lot of people talk for a while like, oh, there's no way this will ever end. Once you start sort of hearing this will never end, that should probably raise some red flags for you. And then you'll start to see some sort of chinks in the armor. Oh, okay. That it didn't make the numbers it was expected. It was expected to do 47% growth, and it did 45% growth. Okay, well, maybe that's a chink in the armor. Maybe it shouldn't be a concern. And then you'll start to see things reach. Oh, okay. They start to come up with some new technologies, in that space that are adjacent to it that you're like, that seems like a reach. That doesn't seem to have any idea what it's doing. It went from really understanding what it was doing to, we're not really sure what it's doing. And then maybe it misses another quarter, and people start making excuses, and they'll start going, well, this is the financial analyst's fault. They've set expectations way too high, or, well, that was, something drove it. And at that point, those are the types of things that probably are going to tell you, hey, the boom of it is probably, going to start to slow down. Now, it doesn't mean that the trend of it will die off and go away. It just means, the explosive, everything to the right, everything's great days are, they're starting to correct themselves. The market is starting to correct themselves. They're starting to say, hey, the valuation of that is way too high. That's probably the point where, somewhere in one of those first chinks or a couple of red flags, if you've seen it historically, you may want to start taking some profit out of it, taking some things, sort of, what we call sometimes, stashing away dry powder, having assets that you can take out of the success that's happened in the boom, so that, you're prepared when things happen. And then unfortunately what happens is once the booms start to crash, they crash very, very hard. And people unfortunately are never quite sure, when to get out of a boom. The problem of it is, for many people, especially individuals, is, they start to have, all of the sort of biases that become problematic. They have, sunk cost bias. Oh, well, I've already been in here for a while, I don't want to get out. Or, oh, it's really high and I don't want to pay taxes on some sort of gain in this. Or, I've already made a big investment in this and I don't want to walk away from it. The problem is, for individuals, you don't necessarily understand the bigger picture of things, which is, as individuals, you probably can't impact the boom all that much. But the people who have very large stakes in the boom, whether those are investors or, financial institutions or whoever, those folks are very, very disciplined in their ability to say, hey, the model has changed. The model no longer matches what we were looking for before. We are going to make sure we get out because it doesn't look like our model anymore. Not because they're panicking, but just they're very disciplined and model driven. And what that tends to do is it tends to create, not immediately panics, but it does create sort of, okay, there was the first thing that, raised a red flag. Somebody got out. Some large financial institution got their money out. And then what tends to happen is you tend to see a lot of sort of follower mentality that will happen. And this is kind of what we've been seeing the last few months, right? The first couple companies that, maybe had to lay off some people were like, boy, I don't want to take the PR hit of being the company that's kind of identifying, hey, maybe the good times are over. I don't love the idea of being the company who has to tell my workers maybe in the fourth quarter near the holidays that we're laying off people. I don't want to be the company that, has to maybe embarrass the CEO and say, hey, we didn't make a quarter or 2 quarters or 3 quarters. And, we're having to refocus and restructure. Like those are difficult things to do. And some people, they can be very embarrassing. But sometimes you're the first one to do it. And you're going to take some blows. You're going to take some, especially if your company is larger or you're part of something in which people are going to say, well, you have a lot of money, you shouldn't be laying people off or whatever it might be. But then what you tend to see is once that initial, kind of PR blow, the industry pushback, the, disbelief that something's happening or the disbelief that, hey, this isn't really the end of a boom, then you tend to see a lot of people go, okay, a lot of companies in particular and a lot of leadership and a lot of VCs who start to go, okay, maybe there's more information there than we thought. Maybe they know something we didn't know. And the crashes and the pullbacks tend to happen very, very quickly. And they tend to happen, kind of follow the leader or follow the pack. And that's what we've seen, a lot here the last quarter or two, which is, so-and-so laid off some people. They laid off people. They laid off people. They laid off people. And, what tends to happen is a couple things, the air cover is sort of there in place. Oh, okay, somebody else went before us. So us doing it isn't perceived to be so bad. You don't take as much of a PR blow. But the other thing that tends to happen, and people don't always understand this, is, as a business, the last thing you want to do is sort of death by 1,000 cuts. You don't really want to be, having to hang sort of a gray cloud over your employees and be like, well, we let 50 people go, or we let 100 people go, but we're also going to let 100 people go next month, or, 200 the next quarter. What they find is, it's really painful to do it one time, to have sort of a large cutback, a layoff, a change in direction. But once you do it, you do create sort of a starting over situation for the company. You don't create so much uncertainty for the people that are left. They're the ones you go, look, this is where we are from now. We're gonna make some changes. You have some frank conversations, some difficult conversations, but then you can kind of start over, and you give yourself leeway to go, okay, we can move on to some new things and sort of maybe abandon some stuff that wasn't that was tied too much to the boom. Maybe you didn't get in early enough to be successful with it. Maybe you made some bad bets. But that's the way this stuff tends to go. Is it tends to be slow in the boom days. People aren't really sure when to get in. They do get in eventually. They don't always know when to get out because when things are going well, it's like being at the casino. You're just sort of riding a high. People tell you all the time, "Oh, this will never end. Look, this is the new normal." We will all use Zoom forever. We will all have everything delivered to us, via Grubhub. All of our meals will be delivered. Everybody will, stop doing retail shopping and they'll do everything via Amazon. And then we see, kind of return to the mean as opposed to quote unquote the new normal begin to happen. Again, these busts, sometimes they're a year, sometimes they're a year and a half, sometimes they're 2 years. With our industry, people tend to be, again, highly innovative, highly motivated to get back to innovating. A lot of times there's still a lot of money in the industry somewhere, in investors and so forth, that's looking for new things to put money into. And if they're into technology, they tend to stay in technology. So, right now we're in sort of a tough time. You probably know some people that, maybe are on the other side of job announcements, which are never fun. But those things happen. I think the big things to sort of, try and do, and again, this might be the wrong advice to give now, but, it sort of goes to our inability to always know when the bottom of booms are going to happen or when crashes or down cycles come. One of the things that you kind of want to do as things are going well is, this is sort of dad advice, I guess, but, you want to be looking at, how do I stash away some money? How do I stash away some capabilities that, while it would be great to leave them in the market and leave them to get great returns, the people that do the best in sort of busts are the people who had been stashing away. And, when busts happen, we tend to see prices come down. We tend to see, assets be available at lower prices, sometimes, crazy low prices. And they're able to, to buy back into things if they have ideas or, ride through, kind of ride out some down times or slow times and so forth. So, maybe not the best advice to give folks right this second because the markets have been down and maybe some things have been cut back or whatever. But, as you're thinking about, okay, what can I learn from, the current somewhat downturn that we're in, it's how can you be taking some things out as things are getting better so that you have more opportunities when things turn around. And that may not always feel like the best advice. You're always sort of thinking, your inherent natural thing is let's let it ride. Things have been great. I think these are going to continue for a while. But they do end at some point. We've seen that obviously over the last 6 months, 12 months, depending on your perspective, where you are in the industry. So, anyways, hopefully some of that was sort of interesting in terms of thinking about, how do these cycles work? What tends to happen? The booms tend to be sort of slow. They sort of grow up in the middle. They tend to crash very hard, and then we tend to see a lot more reaction that is very swift after the booms start to. Either the bubbles burst or the booms become crashes and so forth. And you have to be sort of prepared that, the leeway that you were given during the good times oftentimes doesn't come when things are tough. You have to sort of be prepared for those types of things. It's not always fun. It doesn't always make for great conversations, but, again, the reason we do some of these Sunday perspectives is to remember that, the historical context of things do tend to repeat themselves. It's important to know what's happened in the past because as things are evolving, it gives you some ability to sort of look at it with a clearer lens than sometimes you have if you're right in the middle of it and you just think, okay, we're only in good times, or my sector of the industry is can't be beaten. We can't be slowed down. We're too important to whatever the world is or whatever it is. But we all become sort of part of a much bigger system, a much bigger ecosystem. And so again, I think it's important. We place a big emphasis on it. Not everybody does. But hopefully some of this can be valuable to you, especially if you are newer to the industry and you're trying to make your way, you're trying to grow, you're trying to figure out where to invest your time, your energies, your money. So anyways, maybe a little bit heavy before the holiday season. Hope everybody's doing well. Definitely something to think about though, because as we get into the new year, our industry isn't sort of a continuum. It tends to start over every year. And so it's good to start preparing yourself for, what a starting over year might look like, especially if the starting over year, January 2023, is part of something that will be, part of things being a little slower than they were before, and business people starting to go, okay, what do I have to do? What do I have to reset? What do I have to refocus on? What do I have to prioritize to be successful in this new period of time that will have, a finite quarter by quarter or 6 month or 12-month window of how they're measured for success. So anyways, with that, thank you all for listening. As always, we sent out a note first time that we ever went over 2 million listens for 1 year. We just went past that here about a week or so ago. Thank you everybody for listening. Thank you for listening continuously week in and week out. Thanks for telling a friend. Thanks for helping us grow the community. We're already beginning to start to record some of the 2023 shows. We do what we call look ahead shows in January, and we're already starting to record those. So far, they've been really, really good. So we're excited to finish up 2022 with you. And we've got a lot of interesting things for 2023 already in the hopper. So with that, I'll wrap it up. We'll talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.